This is Chapter 12, Video 3. Let's launch. Greetings, everybody, and welcome back to class. We're going to talk about fringe benefits. This is actually another area that I think is very important to kind of understand. Again, a lot of this is because of it's at the individual level. There can be some significant effects on it. But more importantly, I think that there's also some things that are very important on the company side. But again, this is actually a question I do get a lot from students. Hey, fringe benefits, when they get their first job offer, what's going to be taxable to me, what's not going to be taxable to me. Even some of my audit students who decide not to go down the dark side and not follow my path of going into tech. I'm sorry, I had a tear there for a moment. But they don't do it. And so they come back to me and they say, hey, explain to me the tax benefits. I'm like, oh, okay, yeah, that's fine. So, again, this is going to be, sort of non-cash benefits to employees in addition to their cash compensation. So, again, this is kind of like these are like little freebies, but at the same time, it's more valuable to you than it costs the company in order to provide them. And so, things like they say, common stuff, health insurance, to exotic. I've never worked at a company that let me borrow their corporate aircraft. I'm still looking for that job. But, it could happen. I mean, especially if you're talking very highly compensated individuals. Sometimes you need to be able to get from point A to point B and can't worry about airports. Me personally, I'd rather just go first class. Have somebody pamper me. That's fine with that. It is taxable to the employee upon receipt. And RC 61 does indicate that gross income means all income regardless of source, including compensation for services, fees, commissions, fringe benefits, and similar items. So again, this is income. This is officially income. Now, there are certain times where the IRS comes back and says, look, we're not going to treat this as income because we think it's going to be a better deal for the long-term effects of it. And we'll talk about some of that stuff and why. All right, so taxable fringe benefits, basically it's going to be anything that is not specifically exempt. That's all you really need to know about taxable fringe benefits. So unless there's a specific exemption within the tax law, you have to recognize compensation on it. So for example, if I'm here at the Beta Solutions, I have an employee. And she comes to me and she says, hey, Kevin, I don't know how to do taxes because she's not an accountant. Would you mind doing my taxes for me? Okay, sure. Why not? I can do that for you. And obviously I'm qualified. But the fact of the matter is we do the tax returns for them and then provide it to them and then they sign it and all that sort of stuff. Technically, that's compensation to them. And so when that happens, if that happens, it hasn't happened yet, I would actually have to include it as compensation into that individual's wages. Now, of course, probably a more common example of that would be if I worked for a corporation and the corporation was getting tax services done by some of their key employees. And they said, hey, Kevin, we really like you. We're going to try and take care of you. We'll have the, KPMG prepare your tax returns for you on behalf of us. Would you be interested? I'd be like, okay, yeah, sure. That sounds good to me. And so they go ahead and they give it to me. I have to be compensated at that. And I remember at KPMG, that was actually something that we would do. We would actually try to throw into their tax return, into their compensation, the tax benefit of having their tax returns prepared. So that's kind of what you really need to focus in on this. So you must recognize a certain amount of gross income when they pay life insurance premiums. So very common thing, you'll have life insurance premiums. Usually it's up to $50,000 of benefit. Now, I want you to understand, this is life insurance for that the beneficiary is something other than the corporation. Okay, so the corporation has what we call key man insurance. Like say, for example, Beta Solutions, there could be a policy put onto me in case something happens to me and I die. The corporation then gets the money so it can close things out. That is something that they could end up doing. Again, you subtract. This is how they kind of calculate it out. A big thing where you're going to probably notice this more than anything else when you're preparing somebody's tax return, and you'll see a little C, and then there's like, $35 on there or something like that. That's the value of what they provided above and beyond the $50,000 in life insurance policy to these guys. Again, that's probably the only way that you're going to actually see that. Okay, this is going to be the uniform premiums for $1,000 worth of term life insurance protection. Probably something useful to happen if you have to calculate this, but other than that, it's probably not going to be too much important for you. So the employer consideration for taxable fringe benefits, you are going to treat tax benefits just like cash compensation. So if I provide you with $750 worth of tax services as an employee, I can deduct $750,000 of income from here. You have to recognize $750. And again, it's that big balance sheet that we have. You want to make sure that the balance sheet is maintained. So for the outlay of a cost benefit, the employer must as it has an outlay for it must pay the employer's share of FICA taxes due on that. So I would have to pay, if I had it for my employee where I did their tax returns, I'd have to pay the portion of the Social Security that's tied to that. That's important. Okay. So you deduct the cost of the benefit plus FICA taxes, not the value of the benefit to the employee. It's the cost of the benefit. So for example, if here at Beta Solutions, we charge, we'll say around $850 to do a tax return. If I have one of my employees and I do their tax returns for them, I got to charge $850 to their compensation account. Okay, so that ends up being the way that this works out. Again, the big balance sheet. If I provide a service, they have to include an income. I get a deduction as a result of that. And I think also part of the reason why they do this is that they want to encourage the employee to actually account for this. And that's actually an encouragement if you're going to give me a deduction. This is an excerpt from the 2019 proxy statement. You go ahead and pause and you can kind of read this. I'm not going to get too much into it because this video is already only halfway through and we've still got a lot of material to cover. But, for the most part, they're going to talk a little bit. This is the kind of their proxy statement that they say, the prerequisites and other benefits that our NEOs received. Okay, so that's going to be kind of important. Okay, so then there's non-taxable fringe benefits. These are the goodies. Okay, so they're specifically excluded from taxable income because of the code. They come back and they say, look, if you have this kind of a benefit, we specifically say you don't have to pay taxes on this, and that's a good thing. Okay, so the employee excludes the benefit from taxable income. The employer does get to deduct costs, and that's the best part about this. It's kind of the best of both worlds. Very common ones they have: group term life insurance, like I said, up to $50,000. Health and accidents insurances and benefits. So if I provide health insurance for my employees, I get to deduct the cost. They don't have to pick it up in income. Life is great. Meals and lodging for the convenience of the employer. So here during tax season, I go to my employees and I say, look, I'm going to buy pizza in order to convince you guys to stick around till 9 o'clock tonight in order to do tax returns. Knowing my employees, they'd be very happy to get that. And generally during tax season, we tend to do tax season dinners like that when that ends up happening. Employee education assistance, I can do up to $5,200. I think it's $5,250 every year. And I get a deduction for it. They don't have to include it in income. Life is great. Okay, and then you have dependent care benefits, which is, so for example, if I provide dependent care benefits so that my employees can come here and work, maybe there's a daycare downstairs, and I go ahead and I say, look, if you want to bring your child in, drop them off at the daycare, I'll pay half of it. This is going to be a non-taxable fringe benefit in order to encourage you to work. No additional cost services. Looking at it, even though I used the tax return as an example, to be honest, if I did a tax return for an employee, I don't have to pay extra for it. So it's not a big deal for them. I could probably bang it out, and especially for some of my employees, it probably wouldn't take very long. But that's the thing. I could do that if I wanted to, and it would be at no additional cost. Qualified employee discounts. So, for example, if you work at McDonald's, I remember when I worked at McDonald's, they gave us half off the food when we were on shift, when we're on shift. If you were what we call green hats, which were kind of the mid-level supervisors, they got food when they were on shift and then when they were off shift. But it was like within a certain amount of time. And then of course the second level managers could pretty much get it anytime they wanted to, and the top managers could get it anytime they wanted to and bring family members into it. So that was actually no. So the supervisors, the green hats, they didn't get it anytime they wanted to. They just got it on shift, but it was free. It was not something that was done. So there are qualified employee discounts. If you do that, you write it off. You can write off the cost. You don't have to include it in their income. Life is great. Working condition fringe benefits. There's going to be things like, for example, if one of my staff needs to go to CE classes, I can pay for that. They don't have to include that in income. Even though if my staff is a CPA and wants to maintain their license and I'm helping them maintain their license, they don't have to include that as taxable income because that's considered a working condition fringe benefit. De minimis fringe benefits, that's where in order for me to account for how much it's going to be, it's just a pain in the butt. Now, sometimes the de minimis is like $25, but you can also make a facts and circumstances account on it. So, for example, if I bring, and I'm trying to think how I want to do this. Say, for example, I'm going to have a picnic for all my clients, and I tell my employees, "Hey, while you're there, why don't you go ahead and eat?" Okay. If I'm doing like a picnic where I have all sorts of different types of food, so when I do picnics, by the way, my picnics are the bomb. I tend to do massive amounts of pulled pork, massive amounts of beef brisket, all that sort of stuff, blah, 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 so on and so forth. It's impossible for me to go there and say, I spent $1,000 on food. How much of it went to my staff? There's going to be a de minimis. It's more costly to figure it out than it's worth. And so that's going to be kind of the de minimis. Okay, qualified transportation. So if you live far away and I say, look, in order for you to come to work, I'm going to provide you with a transportation benefit. Could include parking benefits also. I remember when I was working at Gelman, they used to pay for part of my parking because we worked in a building that was actually very expensive to park in. Now, what will end up happening is whatever the government sets as the parking fringe benefits, that's usually what your price is going to be because they don't want you getting any special benefits off of it. So they're going to max it out as much as they can. So I remember it was like $265 a year when I was working at Gelman, and so as a result of which the parking garage charged $265 a year in order to be able to get your parking with it. So that's kind of how that worked out. Cafeteria plans and flexible spending accounts. So for example, if I provide and this is going to be kind of like a mixture of plans. The cafeteria plan, why does it mean cafeteria? Does that mean food? No. It means, look, I'm going to give you this wide range of benefits that you can pick and choose from, and these are going to be qualified non-taxable fringe benefits. And there's a list of them. I'm not going to go too much into them just because it would take a long time. And then you have this flexible spending accounts. So for example, if I do a health, flexible spending account, I can put in a certain amount of money every year. As a result of which, if I use it for health care, I can go against it. That way I can use pre-tax money in order to do it. The bad news about this is always use or lose. You can also have dependent care flexible spending accounts. Again, it's use or lose, so that's important. Employee and employer considerations for non-taxable fringe benefits. Again, the best part about this is employee sees no income. We still get the deduction, so it's kind of seen as a best of both worlds. And Exhibit 1210 is going to have common forms. Again, they're going to talk about, meals or lodging provided for the convenience of the employer. That's a very common one in the accounting industry, especially during tax season. I remember when I was at KPMG, they used to have this huge menu of places that you could order from, and then they'd have it delivered to you, which was kind of neat. Usually I would go to like, Olive Garden or something like that nearby. Of course, that was before I was on keto. And all that sort of stuff. So that's kind of the thing. So that's kind of how that worked out. And again, these are some additional ones that are actually pretty useful to go over. Cafeteria plan, like I said, a plan where you can choose from various non-taxable benefits or cash. Taxable to the extent the employees receive cash. So if you receive cash part of this, you got to include that. In other words, you can't convert this to a cafeteria plan just to get out of paying taxes on it. That's not how this works. So some good tax planning that you can do. An example, the employer, they're going to reimburse $200 a month for parking costs. What if it is taxable? What's non-taxable? Well, it's up to $2,400. So like I said, the employee can exclude up to $270 a month as qualified transportation benefit. Again, luckily here at Beta, I don't actually have parking where I have to pay for it, so this is actually something I don't have to offer. But there are several buildings. Like I remember when I was at, like I said, Gelman had it. Watkins didn't have paid parking. They actually owned the building that they had owned the garage, so it wasn't charge parking. Very common in downtown DC. You'll see this a lot, especially with that. But again, they're going to the $270 a month. That's what your parking fee is going to be when you're there. So that's actually something that you need to just note. These guys are not stupid. They know what they're going to be able to get. And generally, if you take a look at how much daily parking is going to cost in downtown DC, it's far more than this $270 a month. But it's guaranteed income for them, and so that's one reason why they do it. Fringe benefit summary, taxable and non-taxable can be a significant part of employee compensation. I would say especially health insurance. I'm actually buying health insurance for Beta, and now I see how much it actually costs. Boy, is it expensive. The good news for me is that because I'm broke, and when I say broke in is probably the synonym for it. The Veterans Administration pays for all my health insurance. It's actually a good deal. Taxable benefits are usually, it's a luxury perk, while non-taxable benefits are usually excluded for public policy reasons. Again, transportation. We want you to take the bus instead of driving in. We want you to take the metro instead of driving in. That's kind of the reason why they do that. You should be able to distinguish between taxable and non-taxable. That is true. Probably more important if you get into payroll compensation or if you work in financial accounting, it's very important. Yeah, even if you go to financial accounting, folks, you're not getting away from tax. So, get used to it and get ready for it, okay? And then this is going to be, summary of, this is actually from one of the examples that we did. You can actually look at that example and see how that worked out. All right, so that's all we've got. That is chapter 12 wrapped up. It's already backed in the book. And so, guys, I hope you enjoyed it. I hope you learned something from it. If you didn't, feel free to reach out to me to ask for a consultation about this. I'm happy to talk to you guys about it. And I look forward to seeing you guys in the next class.